This is our Forex blog for March 8th, 2012. And like we do most days, we want to buy the strongest currencies versus the weak and sell the weakest versus the strong. We have the real-time strength and weakness in histogram form on the top. This is made up of 5 of our best statistical tools. 3 of them measure the direction each is moving compared to all the rest, and the other 2 measure the intensity, both on a bar-by-bar basis and over the last 30 or 40 minutes. We average that together to give you a very smooth reading. And basically what you want to do is you want to find extreme weakness, in this case, coming up to before midnight, at and above our 80 level. And then during the pullback, because markets don't usually move up more than an hour to 3 hours at a time without a half an hour to 2 hours pullback, during the pullback phase, you want to see very insignificant amount of momentum in the counter trend. Extreme weakness, virtually no strength, that weakness is likely to continue. And so underneath that we have the daily, weekly, and monthly trend. In the dollar's case, the daily trend shifted down a little bit before midnight, but the weekly and monthly trend are still up. The yen, on the other hand, same pattern. The daily trend was already down, and the monthly trend's down. So if you had your choice between the 2 pairs, you would choose the yen. The odds go up. Now let's look for one that's strong on all time frames at that time. The CAD has the best long-term overall trend, but it doesn't have a whole lot of momentum. The New Zealand has a lot of strength right there, as does the Australian, and the Euro does. So if you want to, unfortunately those 3 all have a weekly and monthly trend that's down, but the least intense down trend is with the Euro, and so it has a lot of strength right here. You might look to buy the Euro, the strong Euro, versus a weak yen coming up to midnight. Let's take a look at this chart. This chart also has an NR7 pattern here, which means basically during the previous 4-hour period it went sideways for the most part, and it had a very low volatility. In fact, the NR7 stands for the narrowest bar in the last 7 bars. That's very significant when you look at 4-hour bars. Over the last 28 hours, this 4-hour bar was the smallest and least amount of movement. And so when breakouts happen after an NR pattern, it increases the odds of a very significant trend. And you can see it went from about 107 up to 108.25. So the fact that the currency meter showed you to look for buys, the fact that the price is above the hourly, the fact that it had a very low narrow range pattern, and I'd like to say that it also was above the previous day's high right here. It just kind of broke out above it, came back down. Usually false breakouts cause counter trend moves. In this case it didn't. That adds to the probability too. So, the trades I would have taken is right here when it broke out through the high. Unfortunately it didn't go up that much. I would have got out here with a very, very tiny profit or even a 5 pip loss. Notice it pulled back. It started to go back up again. You go long at 95. You're out right here at 14. So that's a 19 pip move. If you lost 7 or 8 pips and then made 19, you still have a profit. And usually I wait for at least a 15 pip pullback before I buy in. So this one doesn't really necessarily look like it's enough of a pullback. Plus it's near the upper containment band. And the previous week's low is there, and it's a major resistance area. So I probably personally wouldn't have bought the first time. But the fact that it went sideways here, this is one of our entry methods. We look for pullbacks, and we also look for sideways consolidations. This is another sideways consolidation, very much like the narrow range pattern over the previous 8 hours was. So when it broke out right here, you're in again. And usually when it's above the upper containment band, I have our Fibonacci profit target levels up there. I'm going to try to find the lowest low in the last 8 or 9 hours, draw my fibs, and I'm going to get out somewhere up between here. Notice it went almost to the pip, to the 1.618 fib target, and it was one of my fib targets I drew last night as well. So the last trade I would have personally taken is in at 24, and I would have got out of half my trade here at 56 for a 20-something pip profit, and then when it went up to the 1.618 fib, I would have got out of the other half. So my average exit would have been somewhere in the middle here, around down to 65, and we're in around 25. So that's a nice 40 pip move. Now you can see the upper containment bands ratchet up. I don't like to buy. Pretty much the maximum I will ever buy above the upper 2.0 white containment band is about 15 pips. So I probably wouldn't have bought this, but when it pulled back a little bit more and started to go back up, I'm in. And I realized that above the upper containment band, it's usually likely to reverse. So you draw your fibs on the last one, and I'm going to get out at the first or second fib target. In fact, when it went sideways right here, I would have exited half because I wouldn't have necessarily. There's probably a 50-50 chance it's going to pull back. So I would have got out of half somewhere in here when it pulled back. Let's just round up to 90, we're in this trade at 60. So I would have made 30 pips in the first half, and then I would have been looking for this part to get out. It went all the way up within a few pips of the 1.618, and I want to get out of the second half here at 14. So 14 and 90. Let's just say I got out at, let's 95 in this last trade at 60, another 35 pips. And when it's this far above the upper containment band at the Fibonacci profit targets of this level, it's the 2.0 level of the night before, which most of the time never gets hit. I'm going to wait for this upwards momentum to kind of slow, and this is really enough for me. When it kind of goes sideways right here, I would have probably sold here, and it went down about 15, 20 pips. That's enough for me to at least exit half my trade with 8 to 10 pips. I would have got stopped out in the second half. Came back up again. We got a counter trend signal right here, and I'm looking at this point at 9 o'clock to sell. And the easiest way, and I think the lowest risk, highest probability way, is to use a range chart. So you can see when this signal generated right here, I'm going to draw my trend lines underneath these bars low, and I'm going to sell right here at 0.2 with my stop just a pip or two above the high here. I'm risking 10 pips, and as you can see, our intelligent trailing stop got you out right here at 84, about a 15, 16 pip profit, because it's up statistically too much. And, you know, in fact, you also can put the 3.0 band on the chart. When the markets are above there and kind of go sideways for a couple bar, you can look for a quick little scalp short at 26, out at 12 for over a 10 pip profit. Again, it's right near the upper band. Short again here at 23, out at 01 for another 20 pip profit. You could have actually started doing that because it is at an extreme level, but it is only for advanced traders and traders that have bigger accounts. If you don't have a, I would say minimum $25,000 to $50,000 account, I wouldn't look for counter trend trades, because what I do is if I have a loss in the first trade, because of such a high probability of a reversal, I oftentimes double my lot size on the second trade. So let's say I lose, for example's sake, 10 pips with one lot. I'll do two lots right here. So 22 out at the whole number minus the spread. Let's just say I made 15 pips with two lots. That's $300. I lost 10 pips with one lot, which is $100. I've netted $200, which is basically 2 times what my initial risk was and my initial loss. So, you know, again, I'd trade a lot more lots than that, but you get that for illustrative purposes. If you have a bigger account, you can take counter trend trades with, you know, your normal size lots, or even 75, 60% of your normal size lots, and then double up on the second time, because usually there's no one left to buy at these extreme levels, and you're usually going to get a 10 to 30 pip counter trend move. Now, the dollar was also weak, but the weekly monthly trend was up, but nonetheless you could still have bought the euro dollar. Notice 2 narrow range patterns in a row. This is one of the highest probability signals you'll find in our software. It doesn't happen that often. You might find it once a week, or no more than 3 times a week for all the currencies you watch. When these break out, they tend to give you big trends. So you got to pull in. You might even want to trade 1.5 times your normal lot size on these things. So you're in at 54, out at 71, and it pulled back and found support here. I would have, because of the probability of this pattern, I would have bought this right here and probably not made much. I might have even got in again right here, and again that didn't lead to much. So then I'm waiting for the high to get broken out, and it does. You know, the previous week's low right here, and notice our trailing stop got you out up here at 16, in the trade around 86. Let's just even round up to 90. You made 26 pips on that trade. And you have another nice, beautiful little, and I say the minimum is 30 to 45 minutes, a little bit over an hour, flag pattern right here. Because of the incredible strength here, you might want to take that trade. I wouldn't go super large lots because the weekly monthly trend was down. If the weekly monthly trend were up, you know, this is one of those things that you would want to trade a little bit larger lot size on. You draw your fibs on there, and most of the time the market goes to the first or second fib. Notice the high of this is 64, the fib is at 66. It went to within 2 pips of that area and pulled back. So if it shoots through the first fib and it comes real close to the second, you want to just get out of your trade, maybe somewhere up here at 58. You're in this at 22 for a nice 36 pip profit. Very, very nice. The New Zealand, also very strong. So was the Australian. Let's just quickly, you know, look at these charts. Australian yen just straight up. The The New Zealand yen also straight up and also had a narrow range pattern. So when you learn all of our individual tools and how to trade individually with them, and you add them together, you spot patterns that are even higher probability than any one signal by itself generates.